Most homeowners are told that FHAs are the easiest way to qualify, but what they don't know is that conventional loans could actually save you thousands of dollars over the lifetime of their mortgage. Today, I'll break down those differences so you can buy with confidence. So, first thing we're going to have to do when we discuss a conventional loan is who's backing it. And unlike FHA and VA and the USDA programs, these loans are not government backed. What does back them are Freddie Mac and Fannie Mae, or Fannie Mae and Freddie Mac, respectively. That's the standard, and that's why we call them conventional loans. Now, conventional loans could be used for all purposes. They fit all bills. They can use them for primary residences. You could use them for second homes. You could use them for investment properties. You could use them for vacation homes. You name it. Conventional loans are a wider array of uses that it has versus other loan types. Which is why it's so popular. Why it's the most common type of mortgage in the United States. Some minimum requirements when you are doing a conventional loan. So when we're discussing credit score, the technical minimum is a 620 for the credit score. With that said, a 620, a mortgage loan officer still may shy away from offering a conventional loan because your rates are going to be higher and you may benefit more from an FHA program. If you really want to get the most bang for your buck on a conventional loan, then your score should be, if not low 700s, higher 700s. That's where you're going to see the better rates, and that's where it's going to be more worth your while. First-time home buyers, their minimum requirement for a down payment would be as little as 3%. For first-time home buyers, if you are a repeat buyer, for my repeat buyers, it's going to be 5% minimum down payment when you are doing a conventional loan, which is still pretty fair. Another key aspect that we have to discuss when going over a conventional loan and qualifying you for your conventional loan is your debt to income ratio, your DTI. This, in simpler terms, means how much of your monthly income is going towards paying your debts. Most lenders want that to be 45 to 50% of your total income, if not less. So, for example, let's say you're making $4,500 a month. Now, 50% of $4,500 is $2,250. Lenders are not going to want to see you paying $2,251 or more towards your debt every month. Now, this is going to include your mortgage. This is going to include your car loans, student loans, your credit card loans. This helps make sure that you're not only bringing in enough income, but you're realistically able to commit that income towards the home and the loan without being stretched too thin. Also, you must be able to show stable income and stable employment. The magic number is 2. 2 years of consistent employment, consistent income. You can make a lot happen with 2. There's some instances where you could use 12 months, but the magic number is 2 years. You can prove this consistent income with the use of W-2s, 1099s, or self-employment. Now again, if you're self-employed, then it's got to be for 2 years or more. It's got to be a consistency that you're trying to prove. It's not about a huge number. No, that does help. It's about consistency and you consistently receiving this income so they can rely on that when they know that you're going to be making payments back on the mortgage. We went over it briefly, 3% down for first-time home buyers through the Home Ready and Home Possible programs. Let's talk about those 2 amazing programs underneath the conventional umbrella, Home Ready by Fannie Mae and Home Possible by Freddie Mac. These programs are designed to help buyers with lower down payments and moderate income become homeowners. Both allow you to buy with as little as 3% down, and this could come from your own funds, gifts, or even local down payment assistance programs. The credit score minimum for both of these programs is 620, but you'll get much better pricing if your score is 680 or higher. One key difference between these programs and a standard conventional loan is the income limits. To qualify, your income has to be at or below 80% of your area median income, or AMI, for your county. That's how to keep the program focused on helping moderate income families. Another perk is that the mortgage insurance is cheaper than a standard conventional loan, which means lower monthly payments. Both Home Ready and Home Possible are especially popular with first-time home buyers who may not have 20% down payment saved in order to eliminate PMI, which we'll discuss a bit further, thus providing the flexibility and long-term benefits of a conventional loan versus FHA, where the mortgage insurance is fixed into the entirety of the loan. 5% down is the standard for a conventional loan, where 20% down is going to eliminate PMI, which stands for private mortgage insurance, which could save you hundreds monthly and thousands over the lifetime of the loan. And also, gift funds are often allowed in conventional loans. Mortgage insurance is required if you put anything less than 20% down. It can be removed once the loan reaches 80% LTV, or loan to value. And that's the advantage that the conventional loan has over FHA, which has, again, the lifetime mortgage insurance. Their mortgage insurance is built into the lifetime of the loan versus the conventional loan. You could eliminate it at 80%. It automatically gets removed at 78%, but you could request that it be removed once you hit 80% equity on your house. Once you pay off 20% of your house, you can request that your PMI is removed. Now, there are loan limits when qualifying for a conventional loan, and the loan limit in 2025 does fluctuate, just change year by year. In 2025, that loan limit is $806,500, higher in some other counties. The higher cost areas like New York City or Los Angeles, or Florida, just to name a few, goes up to $1.21 million. So when we talk about loan limits for a conventional loan, we're discussing the maximum loan amount that Fannie Mae and or Freddie Mac will buy. So that's the key. That's the loan amount, not the purchase price. The loan amount will have to be underneath that cap number in order for it to qualify as a conventional conforming loan. Or at the number. It has to be at or below that cap number in order to be considered a conforming conventional loan. So let's say you're buying a home that's worth $850,000 with 10% down payment, which means your loan amount is going to be around $765,000. This number is underneath the cap, $806,500, which therefore means it will still qualify as a conventional loan. It's a lot of numbers. Hope I'm not losing you. The point is, if this loan amount goes above that limit, then it's going to be considered a jumbo loan, which has stricter guidelines and often higher requirements. So know your county's limit before shopping. Like I said earlier, there's a reason why conventional loans are the most common and popular loan in the United States. It offers many benefits. It offers competitive interest rates. The PMI can be canceled. You can use it to purchase condos. You could use it to purchase vacation homes. You could use it to purchase rentals. And you could build equity faster with strong terms. Now, who should consider a conventional loan? Buyers with good to excellent credit, buyers with at least 5% down, 20% down, you need to consider a conventional loan. Second home buyers, vacation home buyers, investors are those who simply don't want to buy and pay for PMI for the lifetime of the loan. Here's an example of how a first time buyer can get into a home with just 3% down. The home price is $250,000. 3% of that purchase price is $7,500, which will have to come out of pocket in order to get a remaining loan amount of $242,500. Now, this homeowner here in this example has a great credit score of 720. The monthly debts that they have reoccurring is $500, and the private mortgage insurance PMI on the home is going to be $125 a month until the 80% loan to value LTV is reached. And this is an estimate. Again, PMI is able to be eliminated from the equation once 20% of the home is paid off. Now, when lenders look into your recurring debt to income ratio, and the number here we're using is $500, it's not so much about your full balance, even though the lower that full balance is, the less debt that you have towards your income. What's most important is your minimum monthly payments. So that's what's actually going to hit your budget, and that's what's calculated when you look into your debt to income ratio. So again, in this example, it's $500 monthly going towards debt. So whether it's a car loan, a student loan, credit card, or a personal loan, it's the monthly number that goes towards paying your debts that matters, your minimum monthly payment. So that's why in this example, I use $500 as a monthly number going towards debt. And for some buyers, that may be $700 or $800, depending on the kind of loans, the kind of debts that they have. But the principle remains the same. Lenders look at how much you're required to pay each month. The point here is that as long as your total debt payments plus the new mortgage fits underneath the 45 to 50% range for your DTI, your debt to income, you can qualify. So the big takeaway here is with less than $8,000 down payment, a first-time buyer could realistically step into home ownership on property valued at $250,000. Now keep in mind that $7,500, 3% down, is just the down payment. You'll also have closing costs, which typically range from about 2 to 5% of the purchase price. On this $250,000 home, that could be from $5,000 to $12,500 in closing costs. The good news is there are ways to manage the closing costs. Sometimes the seller can help cover them through concessions, and in certain cases, down payment assistance programs can step in as well. So while the down payment is the entry ticket, closing costs are an extra piece that we need to plan for. And I want my clients through both, so there's no surprises. Here's another scenario. This is going to be a growing family, and the home price, and this example is $400,000. This family is putting down 10% toward their down payment, which is going to be $40,000, leaving for an amount of $360,000 for the remaining mortgage loan amount. Their credit score is fair, 700, And in this example, you notice that the PMI drops off a bit more from the prior one because they paid off 10% of the equity. So in this example, they're only paying $9 a month. And the best part about this is temporary until 80% LTV is matched, meaning that 20% of the home is paid off. That's one of the biggest advantages that a conventional loan has over a FHA, where the mortgage insurance is going to last for the lifetime of the loan. So because they paid off 10%, putting down a 10% down payment, their PMI is less, the family gets into a bigger home, and the closing costs for this particular home, again, is 2 to 5% of the purchase price. So in this scenario, it's $8,000 to $20,000. And again, I don't want to confuse y'all. This is called the total cash to close. In order to sign a deal and get your keys for the mortgage loan, the closing costs plus the down payment is the total cash to close in order to qualify entirely for the loan. Now let's look into an investor scenario where we have a homeowner, he's an investor, and he's putting down 20% in order to qualify with a conventional loan to purchase his rental property. The home price here is $300,000. 20% of that is $60,000. Credit score is fair. There's going to be no private mortgage insurance involved because 20% of the home is paid off. So again, the key point is conventional loans also make it possible to purchase rental properties as well. The closing cost, again, is going to be 2 to 5% of the purchase price. And also, I've discussed DSCRs before. The reason why you would consider using a conventional loan to purchase a rental property, typically conventional loans do have better rates. The reason being is because you're qualifying with your income. Due to you using other methods that if you want to look more into, you can click the link up here and you can look more into the trade-offs as to why you would perhaps consider a DSCR over a conventional loan. But just a quick spoiler, DSCRs are going to use another method in order to qualify you entirely. You could use conventional loan to qualify to purchase a rental property, and general rule of thumb, their rates are going to be a bit better than what you're going to get with a DSCR. You pay for flexibility with a DSCR, and it may be worth it, maybe it's not. The total cash to close in this particular scenario is going to be $66,000 to $75,000. Due to there being no PMI, you're going to save thousands of dollars because you're not paying extra monthly on private mortgage insurance. And this is another way that you could potentially purchase a rental property. You can do it through a conforming conventional loan. Let's wrap this up with one more example. And this example is going to be a vacation home or a second home. The home price here is $350,000. It's by the beach. Oh God, if only. But anyway, down payment is $35,000. That's 10% down. The loan amount is $315,000. Credit score is 720. Just rewind a little bit. For second homes and vacation homes, the down payment requirement is usually 10 to 15% requirement, if not 20%, to totally just remove the PMI and the private mortgage insurance. And in this example, it's not because they're only paying 10% down. So again, as of with the other examples, PMI is required, but once they pay off 20% of the home, once that LTV reaches 80%, it could be requested to be removed, or it will be automatically removed once the LTV reaches 78% LTV, if not requested earlier. And the flexibility that I want to show here is that you're able to purchase vacation homes, you're able to purchase second homes with a conventional loan, and this is not possible with homes purchased through other means like the FHA, VA, or a USDA, which usually requires it to be a primary residence where you're living on the property. This one is vacation home. You don't have to live on it the whole entire time. You can have a whole other home and still have this one. So it's a great tool in order for you to build up your monopoly, or for rental landlords to build up their portfolio. In this scenario, the closing costs are again 2 to 5%, $7,000 to $17,500 altogether. That's about $42,000 to $52,500. It's going to be your total cash to close, and then you could have this lovely vacation home out by the pair. It's just an example. It could be a lot more money than $350,000, but you could dream. No, seriously, it's $659,000 in real life. But that's neither here nor there. A man could dream. Anywho, the best thing you could do is get pre-approved. That way, you know exactly what you qualify for, what your monthly payments will look like, and you'll be able to shop for homes with confidence. Again, my name is Nico Jones. I'm with Next to Mortgage LLC. It has been a delight to educate you on the many benefits of a conforming conventional loan. And as always, you could click on the link to apply now. It's on my website. I have multiple apply buttons. If you enjoyed this video, please do consider liking and subscribing. It definitely does help the algorithm, and it helps me be able to push out more educational videos towards you. You can reach me directly at 743-330-1454. My email is listed. Again, multiple apply now buttons on my website. I look forward to hearing your scenarios. We're going to wrap this one off. Good night. Conventional loans, Nico Beans. Stay cool. Cool beans. Thanks for watching, and I look forward to helping you on your path to home ownership.